Welcome back, everybody. Tuesday night, Vetted VA Live. As always, joined by two vetted pros. We may have a third joining us tonight, but a really important topic, especially in the current market. We went from, say, 1995 through about 2022, where most people just did 0-point loans. Rates were low and going lower through that 35, 40-year time frame. So points became less and less of a thing. Now we're going on the better part of 2 years with elevated rates fluctuating where they drop, pop back up. So we have not only buy downs, which we've covered in a previous episode, the temporary buy downs, a 1-0 buy down, a 2-1 buy down. So we've gone over those in detail. Today, we're going to cover all closing costs, but we're going to start with the heart of the matter of points that buy the rate down permanently, what they are, how they work, how they can be explained to you, who can pay for them, how they interact with a VA loan a little bit differently than other types of loans. So let's jump into that. I'm joined by Randy Teakle in Salina, Texas, and Nathan Einkorn out in Colorado. So we've got all corners of the country in the middle covered, or the lower corners of the country in the middle covered. So we can get you all the information that you need. But with that, Randy, why don't you walk us through that concept of a par rate or a 0-point rate, and maybe how you explain it to a client that on any given day, there is not one interest rate. There's a whole stack of rates that we can choose from.
Right. So what I do is I call that a rate ladder. And that's one of the big concepts that people need to understand is when you lock a rate, you're not locking a rate, you're locking a ladder. You're locking the rate sheet for that point in time. And you have the ability to move up and down that rate sheet. Hence why I call it a ladder, because you can go up the rungs and down the rungs. If you go up the rungs, a few years ago, we had different pricing and you could get considerably significant seller or lender credit available to you to help pay your closing costs, etc. And that was in a time that rates were really, really good, but seller concessions were really rare. So going up the rate ladder made sense then, because you might go from that 2.25 rate that was being offered to 2.75 and then not have to bring any cash to the table. And conversely, now we're in a situation where that lenders don't offer a lot above, because the rates are already fairly high to begin with, in the sixes for most of us right now. And so you can go up and down the ladder accordingly, but going up the ladder is not appetizing to most people because of the fact there's not a lot of lender credit without going significantly higher in rate. So that doesn't necessarily make sense. But going lower, people really aren't happy with the interest rate. They want to buy the rate down. Basically, a lot of time I spend my time talking people out of that, just showing them the math that yes, you want from that 6.5 or 6.25, whatever that rate is, you want a better rate, but you don't want to spend so much money that you've tied yourself into that position for longer than what we anticipate the rate market is going to be at this level. We believe, I say we, I subscribe to 4 different rate services, and they all believe that in the next years, 1 or 2, depending on who you talk to, rates are going to come back down. So when you look at buying a rate down, you want to make sure that it's going to benefit you. The amount of money that you spend to get to that lower rate, you're going to recoup it before the rate changes down lower, and you could have just refinanced it for that. So the real question is rate ladder and par rate. So I'm going to explain to you what a par rate is. Basically, like in golf, there's a set price, right? And it may not be exactly right because it's based on 680 credit typically, and that person's going to have a par rate at let's say 6.25. But the person that's got 700 score may have 6 and an 8 for their par rate, but that's the rate at which you don't pay anything to get it. So you're not paying discount points, and you're not getting paid to take it. So you're not getting lender credit. Does that make sense, Josh?
Yeah, that's perfect. So with that, we have this idea of the par rate, which is what most people chose for many, many years, of saying, cool, 0 points. I don't want to pay you. You make money by closing that loan. The lender pays you. I don't have to pay anything out of pocket. So now we flip to the situation, rates are higher, and people go, well, cool, that's the par rate, but I don't like that rate in payment. I want it lower. So we get to this idea of you can have a lower rate. That rate ladder, that rate stack goes much lower, just like it goes much higher. So Nathan, I'm sitting across the table from you, and I go, I want to pay some points. I want a lower rate, but I don't know what points are. How do you explain that concept of points and what it's going to get me as a borrower?
Well, I'd step back 1 second and just also say the par rate for most Americans for the last 25 years was the only rate they were even offered, right? I see this all the time where I'll talk to a client who work in another bank and they go, oh, this is my rate. Okay. Did they show you like the entire rate sheet, the rate card that was available? Because to Randy's point, like you could have taken a higher rate and gotten a lender credit to help with points, or you could buy it down. So speaking of the buy down, the easiest way that I can say it is points when you're buying down your rate is essentially the lender charges a percentage of the loan amount for you to get a lower interest rate, right? And then it's just math. I tell people all the time, let's just math it out. Doesn't make sense. If you're going to pay, let's just say you have a $500,000 loan and it's going to cost, the par rate today is 6.5% and you want 6%, but 6% is going to cost you 1 point. Well, that's 1% of the loan amount. It doesn't buy the rate down a point, so it doesn't take you from 6.5 to 5.5. It's the cost that the lender charges for you to buy that rate down from 6.5 to 6, right? So it's 1% of the loan amount. You got a $500,000 loan, it's going to cost you $5,000. But this is where the math comes in. How much does that save you per month? Now let's look at your break-even calculation, right? And let's just say, it's going to save you $175 a month. Well, how many times does 175 go into 5,000? Let's do the math real quick. And based on, I subscribe to some of the same rate predictors that Randy does, and I think all of us do. And they're all in that same boat. Hey, in the next 1 to 2 years, we're going to see rates come back down. So, one of the things a lot of people want is they want security. They want, to be assured. They want assurance that their loan, this is my payment, this is my rate, and I get that. So if that's your primary concern, cool, let's buy it down. We don't need to worry about the break-in. Sometimes they have to buy it down to qualify, right? Because they're stretching themselves a little bit further on their purchase price. But in the end, like I say, it's just math. If we think rates are going to come down in the next 24 months and it's going to take you 36 months to break even on that buy down cost, then it might not make sense. But I also don't spend money with other people's wallets. So our job as advisors is to give them the numbers, give them the math, and do the best that we can to explain how it works. I also use the golf analogy when it comes to how rates are. Hey, this is par, right? So below par, it's going to cost. Above par, you're going to get a credit.
People don't deal well with uncertainty. They like there to be a fixed and final and certain answer. So just to kind of recap what you guys said here, yes, it's a math equation. We can say paying this point costs X amount of dollars. It saves you this much every month. So here's your break even. But where does uncertainty come in? First of all, we start with your personal uncertainty. How long are you going to live in that house? You get PCS'd out in 2 years and you paid points with a 4-year break even, probably not going to work out in your favor. How about just uncertainty? Like you'd sit and say, oh, I love my wife. We have the greatest relationship. We're going to retire in this house. We're going to be here for 20 years. And then 2 years down the line, a divorce comes along. So despite the fact that we all have a path of how we envision and see our life going, that's great. We want to think, okay, to the best of my knowledge today, with everyone in good health, we all love each other, we're going to be here for this amount of time. But things happen. So we have uncertainty there. Then we also have that market uncertainty that you guys were talking about, that what's the market do? We think believe that rates are going to be somewhat lower. And depending on the size of your loan, it doesn't take a huge movement, especially with a VA loan where we can do an IRRRL with no appraisal, minimal paperwork. And we'll go into that and how it impacts that decision. But we don't know for a fact that rates are going to go lower. So it can be a reasonable decision, despite the fact that those sunk costs could be gone, if we say, hey, I don't know what's going to happen with rates. I think I'm going to be in this house forever. So instead of 6.25, I want 5.75 today. So I will pay 2 points and that's money gone. But we have the long-term view that if rates drop 1% next year, you may end up still doing that IRRRL from 5.75 to 5.25, despite the fact that you paid that money. So we have all sorts of uncertainty. We, Randy, Nathan, myself, if we're doing your loan, we can help you pencil out the math, and you can tell us the path and the projection of your life path and what you think and hope, expect to have happen. And then we got to layer on that fun part of what is going on with the markets on top of that. So we've got all that. And our friend Jerry has joined us. It looks like he was at the Dodger game. I don't know. Is that what it was? You couldn't roll in time because you were at the Dodger game?
Can we blur that screen out? It's hurting my eyes.
It looks like he already blurred it, but he only blurred the background. He didn't blur the Dodger stuff.
Yep.
Jerry, I don't know that we have your mic in action. I'm not sure we're hearing you. So with that, just had a few questions. And the funny thing is we kind of burned through a lot of this because it's not super complex, especially for us. We have the curse of knowledge. So when you know something and it's super easy, but it is complex to other people, it can be a little bit hard to explain. So stepping back, any of you guys watching at home, if you have questions, throw the questions up in the comments. We are happy to get to them. That is actually our number one purpose here, is just to answer and go through your questions. So if you have a question related to points, closing costs, anything mortgage or real estate related, especially as related to using your VA benefits, we'd love to answer them. So throw those questions up there in the comments. But Jerry, you missed. We're gonna bring you up to speed. Randy walked us through kind of the concept of a par rate, how you can take a higher rate, get some money back, pay some points, get a lower rate. Nathan kind of went through the math of what that looks like and how to decide. How about you walk us through how the decision to pay points may be a little bit different for a borrower with a VA loan, knowing that they will be IRRRL eligible in the future, and how that kind of impacts how you advise clients on whether they should be paying points or not.
Yeah. So for me in particular, it's obviously it's always a case-by-case scenario, right? But when it comes to talking to a veteran, you're really looking at really what are the advantages of you taking a lower rate if necessary at the moment. If it is somebody who has a very low FICO score and they're struggling with the concept of even making that mortgage payment in general, and in order to make it work for them and be something that they can feasibly pay monthly, then at that point you have to work with that person or that person's needs or wants in that situation and just adjust to it. Which is when you would be okay with saying, okay, let's look at points, but let's keep it within a certain threshold here. So I really try to limit it to the amount of points to really just given my suggestion based off of a lot of time to recoup. If we're talking about it's going to take a while to recoup that money and it's going to be a few years, it's very likely that I'm not going to suggest that they go with a lower rate unless it's going to work in their favor. And so in this particular circumstance, I'm going to be like, let's look at this and see if it's going to take us 36 months to recoup this versus we can take a little bit higher rate and it's going to take us a year to recoup that. And then in a year's time, possibly we're ready to do an IRRRL because rates came down. Then at that point in time, okay, let's now consider the IRRRL, which at that point you'll be like, okay, let's just say we bought down 3/4 of a point versus buying an entire point or point and a half in rate down, which again, a point for a point doesn't equate, right? It's usually for every quarter you're doing about 0.375-ish to about half a point in cost. So for that big difference, and you're talking about 2-3 points, I mean, it just doesn't make sense when you're getting that high. So it just really depends on the person's circumstances. A high credit client may not necessarily be looking for that much of an improvement up front because they really don't need it. Like you can afford to make the payment based off of the par rate or close to it. Maybe it down a little bit, but that's about it. And again, just working with that particular individual and what their comfort level is, while trying to be the guiding light there anyway, and try to just express your opinion and or really expertise in the matter, and just saying, look, and this is my opinion. This is where I think things would work best for you. But again, you make the decision. Here are your options.
One of the things, Josh, I wanted to point out is that the rate ladder isn't linear in the point. Obviously, it is in every quarter point means $36 less on your point on your payment, but it isn't linear when it comes to the cost. So there's the sweet point, the par rate that we talked about, and the farther you get from that, the more incrementally it's going to cost you for that extra quarter or eighth. And so to the point of there's not a way that you can say, well, if I spend a quarter, or if I spend 1 point, I get this improvement. But if I spend 2 points or 2% of the loan amount, it doesn't equate to the same savings that first point got you. And that's basically what Jerry was saying. Yeah. But the farther you get away from it, the more it gets crazy expensive. So like right now, the market's somewhere around 6.5, 6.25, whatever it is, depending on the person. It's not going to cost you a whole lot to get to 6. It costs you somewhat. But if you think you want to go to 5, it's going to be 4 times the cost that it took you to get to the half point to 6. So I just wanted to point that out.
Well, another piece, it's easy for us to go, hey, it's simple math. Here's the savings, here's the cost. Like you said, the further you get away from that par rate, the more the cost is. But a couple of things, and I don't talk about this with many clients. If you're buying your first home for $250,000, after the 2018 tax changes, we probably don't need to talk about the tax benefits and how, yeah, you're lowering the payment, but some of that is a write-off that you're losing. So that pushes that break even out. Also, if you have a client who's buying a $1.5 million home and they have $500,000 invested, and we're talking, hey, we're going to take $10,000 that away. If this person is an experienced investor and they get 7-8% return on that money, all of this pushes that break even further out and argues against paying those points. So it's not that points are never a good idea. It's just, it's a complex calculation. We have a lot of uncertainty about what's going to happen in your life. And it's personal. So I think, Nathan, you had said earlier, it's not my decision, not Randy's, not Jerry's, not Nathan's. We are here to help you quantify that so that you can make the best decision for yourself. Nathan,
this is why we're this is why we're lenders versus realtors. A lot less emotion involved on our side.
Yeah, absolutely. I would not want to do their job, and most of the ones that we talk to would not want to do ours. There's a reason why people find themselves in those seats. But Nathan, being a numbers guy, maybe for those that are watching, just a brief difference, because they're hearing buy downs, and now we're hearing paying points to buy down your rate. What is the difference between paying rates to permanently buy down your interest rate, like we've been talking about here, versus that 1.0 or 2.1 buy down?
Yeah, all right. Primarily, it's one is a temporary, one is a permanent, or as permanent as your loan can be. Right. So when you do the permanent buy down, that's your rate. It's not going to change. Right now, obviously, I don't think a lot of people are doing ARMs. There's really not a lot of incentive in those products. So 30-year fix, that's your rate. That's where it's going to stay for the life of that loan until you sell or refinance. Whereas the 2.1 buy downs, like I said, they're temporary. And more importantly, they come from seller concessions. So that money for those temporary buy downs is a concession given by the seller. It's not out of pocket. And the great news is with those 2.1 buy downs or 3.1 or 1.0, whatever one it is, if you refinance before that buy down period is over, then the remainder of that, what the funds in that escrow go towards your principal balance when you either sell or refinance the property. But a permanent buy down, that's part of your closing costs. That's in there. It's closing. When you close, that's finalized. That money is not coming back to you. So that would be for me, I don't know if I missed anything, but that's the primary difference in the temporary and the permanent finance.
No, I think you covered it. Like the thing that I like to tell people is the temporary is going to give you a big savings for a short period of time, and the permanent is going to give you a smaller savings for a much longer period of time. Jerry, I'm not sure if it's coming from your computer, but we're picking up a bunch of Windows sounds off of someone's computer. With that, I think we've done a pretty good job of covering points and that number. If you guys don't have anything to add to that, maybe we shift to the rest of the closing costs. And on the show here, we've gone through the loan estimate box by box by box, so we don't necessarily have to go in as great of detail as we have before. But Jerry, why don't you walk us through box A? So if you're paying these points, those points are going to show up in box A. But what else shows up in box A, and what should that person comparing options, looking at their options, be looking at there in box A on their loan estimate?
Yeah, so box A will generally have your origination fees and costs. You're going to have processing fees sometimes in that same box. You'll have again, there's discount points, and then there's the options of some of the lenders that will have application fees and things of that sort. So like that's typically the stuff that you're going to find in box A. And reasonably speaking, I mean, the more stuff you have listed out, for me, it's I try to work it always and say, look, like I'm not gonna nickel and dime you here when it comes to all these other fees. So I'm gonna keep it real. This is the cost, but let's just look at the overall cost, right? Everything that's in box A, this is what it's gonna run you. Versus you're looking at somebody else's loan estimate, and they might break it down into like multiple fees, right? But it might end up being, conservatively about the same cost. And if that's the case, I mean, you're just basically nickel and diamond at that point, and just decide which route you want to go with. But in general, you're looking at a box A having all the lender fees. So that's in general, that's what you're going to have.
Well, what's funny is with that box A, as brokers, we can buy out any admin or underwriting fee, make that go away. Most of us can absorb or don't have a processing fee. Those show up in box A. So we have people in this group that adamantly say box A should be empty. This is what it is. And kind of relating back to today's discussion in terms of what are points, should I pay points? I look at anything in box A as points. If you buy out that admin fee, what does it mean? It means that there was a reduction in the points attributed to that rate. So really, we can apply that to anything in there, because I'm sure you guys have had this before where I'll have a client that will say, hey, I really like your numbers, but I talked to someone and it's cheaper. They're getting me better terms. I go, okay, cool. Let me see the loan estimate. And what happens? Nathan, just tell me. I can see the look on your face. So when you hear that and you look at the loan estimate, what does box A tell you, either in points or other fees?
I mean, well, it's the money that's being. I mean, unless it says discount points, right? And even then, I mean, I think we've all seen these loan estimates. These guys are getting pretty creative now, where their origination fee and discount points are all merged together. They're all the same thing. But in the end, what I tell borrowers is this: there's two boxes that matter that are going to differ from lender to lender, and that's box A and box J. That's it. Boxes B through I, they're all the same. I mean, we don't decide what title company you use. We don't decide transfer taxes. The escrows are the escrows. They are the same. They're collected the same way by every single lender in the country across the board. So those are the ones where. Now, sometimes box B will be a little bit different. You'll see some companies are putting that processing fee down in box B now. But usually when I see that, what I'm seeing is typically when there's like this big difference, hey, these guys are a lot cheaper because I'm, like you were saying, I'm one of those, there's no fees in my box A. There's nothing in there, right? Now, what I will see, though, is you'll see these estimates coming across with a $75 a month homeowner's insurance payment, or a tax payment that just doesn't exist. And usually you'll see, but that can be a huge difference when you're talking about escrows, right? I mean, if I'm putting in $225 a month for homeowners insurance and they're putting in $75, I mean, we're talking, that's an $1,800 difference in closing costs right there, right? Just on that first year's premium. So it's like I said, the only boxes that differ from lender to lender, or that should differ from lender to lender, unless somebody's, juicing their fees or doing, messing with that loan estimate, is going to be origination, like Jerry said, right? You got your discount points, you have loan origination. Sometimes you'll see underwriting, and sometimes you'll see processing, all in box A.
And back to your point, Nathan, like a really good comparison is if someone talks to you and you say, hey, the rate's 6.5 today and empty box A, and they come over to me and I say, well, it's 6.25, but I got $2,300, $2,800 in box A. It's not cheaper. It's a lower rate. It is not cheaper. So again, even though those fees in box A are not called points, this is why I say they are. It's all points. It's the charge for that rate. It is what that lender, that broker wants, that bank wants for that interest rate. So when you're comparing, you have to look at both. And you say, well, Nathan's not charging me anything in there. I say, okay, I cannot charge you anything there either. Here's my interest rate. And now if I go, my interest rate 6.625 with an empty box A, well, now Nathan wins. If I say I can do it at 6.375 with nothing in box A, I win. So for all of us, it's kind of a dance in educating the consumer that they have options, but not overwhelming them by giving you, here's 23 different rate and fee options. Which one do you actually prefer? Because that paradox of choice is real, and people will just bog down and shut down and go to the person who gave them one option that had a low interest rate that involves them paying more for it than they need to.
And I'll say that's why we are mortgage loan originators. And I know this term gets thrown out a lot, but we are advisors. And one of the things that, and this is what I say, like a lot of those people who maybe took a par rate, it's because that was the only rate that was presented to them, right? One of the things that I do, and I know Jerry does this, I know all of us probably do this, or should do this, but when I'm talking to a client, right, they get multiple options. Hey, here's the par rate, but here's the buy down rate. And if it's necessary, right, especially when I'm working with those engineers, here's 6.5, here's 6.375, here's 6.25, 6.1, right? Here's the buy down as low as you can legally go, right? Yeah. But you should be, the borrower should have, and by presenting those options, right, presenting hey, here's a lender credit, here's par, here's a half a point buy down, right? Because that providing that information alone will prompt 99% of borrowers to be like, okay, what's the difference? Why is this rate here? What, you're sending me 3 rates, but, and my wife, now my wife is a processor for me, but previously she used to remind me all the time, hey, babe, people don't talk about mortgages all day. So maybe when you're talking about these, you need to, put a little bit more detail, put a little more time explaining it. And that's the reason. And honestly, like if I remember correctly from the CE that we just completed a few months ago, and from my original 20 hours, however long ago that was, we're actually required by law to present more than one loan option.
Yep.
So
it's a topic for another day, but I believe all four of us are brokers, right?
Yes.
Well, among 4 brokers and the people that are watching, we could talk about whatever we want. So I'm going to shift gears a little bit because it does somewhat relate to points, and it relates to presenting people with their options. A lender that all 4 of us do occasionally send loans to, maybe some of you guys send almost all of your loans to. There's a class action lawsuit that some brokers have literally been shown to send 100% of their loans to one lender, while presenting themselves to consumers as a broker. Randy, I see you shaking your head. What are your thoughts on this? Is your role as a broker, we're talking about presenting options, but also when I tell someone I shop 50 different options for their loan, I literally have 50 different FHA options. Many of these people weren't even approved with a second lender. So in essence, they were a retail arm of that one individual lender. But what's your take on that?
Well, for me, the biggest thing is that I have 50 or 43 different VA lender options. I have a pricing engine that prices my scenario out, and it gives me pricing for all 43 of those lenders. And then for me, what I do is I take the top quarter and I look through that for the ones that I know to have the best operation, etc., and the one that I know that's comfortably going to deliver us at closing without any stress. And those are my choices that I make, just using my expertise and my experience with those. I don't always use the cheapest one, because if we've got a 18-day close, the cheapest one is going to make everybody hate me, right? But I've got somebody in that top 5 that I can pick typically and say, I'm comfortable that this is a very competitive rate, and I'm comfortable that we're going to deliver customer service and not make them have 18 million conditions at approval, et cetera, et cetera. So even though I shop 43, I narrow it down to about 7 that I use if you look at my list. And I'm not set up with the one that you're talking about since April of 21, when they did the whole playground fight thing. But the bottom line is that I shop, and some months I do send all my stuff to one place, but it's typically just because, as we know as brokers, the way that our broker lenders use a faucet to turn on and off volume is, if they're real busy, they raise their rate a little bit, so they go farther down the list. If they're not busy and they want more business, it's easy to turn that volume up by being more competitive. So that's one of the reasons I'm picking the people at the top of the list that operate well, is because that's pretty much what they told me, in just the raw pricing of it, is that they're ready for some business. And then I verify that with account executives. So
I like that. And I think that's really helpful for people looking at home as brokers. What does that mean? People say, oh, you're a middleman, you're getting charged extra. Like, absolutely not. I'm saving you 500 calls because I can go through this and I have vetted these people. Because any given day, to your point, Randy, I have one today that we locked yesterday with the lowest price lender, and it was with some trepidation, but it's a $1.3 million VA loan, and they were a half point better than anyone else I have. Pretty hard to tell your borrower, hey, I'm going to have to beat my head against the wall and probably have some arm wrestling with the underwriter, but you got a 30-day escrow. You're well qualified. There's no debate that we lose that they don't approve the loan. So it's not the smoothest, fastest, easiest process for me. It can be transparent to the borrower. I'm going to be the one that has to do that. But $5,000 is a lot of money. Jerry, how about for yourself on any given month, or let's say of the last 25 loans that you've done, how many lenders would you have worked with in that?
I've pretty much been right around about 5 of them that I tend to use regularly, and 2 of them with more volume than normal, just because they either, again, we're talking about need and want from the client, right? And so when we're talking, let's say a veteran consumer is purchasing in California, but they have like you said, an 18-day close. Like, I already know, like, I have my options really limited to a very small scope, because I need somebody that can go fast and is efficient, right? And so sometimes you're paying for speed and efficiency, while in other situations you can actually say, you know what, this lender is actually better by a quarter, and we're better off going here. Like, the cost makes sense to go here, even though this guy's faster. And again, if we're talking about a 30-day close, you might be able to work that with the other lender that's cheaper. But if you need a quick close, then you might have to go to that more efficient, quicker lender. And so that's kind of the route that I've always gone. And it's present the options to the borrower always. You always have to tell the veteran, hey, you know what? We have a really fast lender that can really get the job done quickly and is known to close, because that's what they do. That's how they do it. But they're going to be a quarter higher in rate. And that's just what I'm using as an example based off of a conversation I had today. They're quarter rate higher than the other lender. But this other lender, not too bad on speed. They're pretty good and they're pretty reasonable when the underwriting is thinking about things. You don't beat yourself in the head sometimes with some of those underwrites. You can go there and it's cheaper for you. My recommendation is going to say, hey, run with a cheaper lender in this situation, because it makes sense. Financially, it's going to make sense. Speed and need is going to make sense, as well as your experience is going to make sense. Like, I can't have you having a bad experience. Like I know if I'm going to be beating myself on the head over and over with the particular lender, I'm going to lay out that explanation before we even send that loan over there. It's clearly broken down saying, hey, buddy, we're going to go with the cheapest lender because that's what you want. But let me just tell you, they may make this hard and they may underwrite the living bejesus out of this thing, but we will make it work. And so you just, prepare the expectations properly, and then you'll do just fine. But again, it's always going to vary based off the wants and needs of that consumer, and you present it and let them choose. At the end of the day, that's the lovely part about being a broker. You can decide of like, here's your plethora of options, you pick, and give them the choice.
Something that you said, and then also something that Randy said, I can piggyback on wholeheartedly. You say 5 lenders. I'd say realistically, it's full-blown 80-20. 80% of those loans go to 20% of the lenders we're approved with because they consistently deliver. They have solid underwriting. They have great terms. They're going to make us look good, and you're going to be happy with them post-closing. So I think for most of us, it's 3 to 5 lenders are getting the majority of our business. But to Randy's point, being approved with 40 different ones, we keep those approvals. There's work annually to maintain those approvals, to keep approved with them and do their documentation. Some of them, even if VA guidelines are what they are, some of them have a weird little special niche. Maybe they do VA rehab loans, VA construction. There's reasons why they're out there. We're going to use them. It's a tool that we have in our toolbox. But the reality is I advise myself the same way I advise clients. Don't go out and say, because we get a lot of online leads. The people say, what's most important to you? I want to get the absolute lowest rate. You really don't. It's like saying, I want the absolute cheapest meal. Do you? Most likely you don't. You want a very competitively priced loan with all of the other good things, as many of those other good things as you can get while keeping that really low. But with that, Nathan, how does that jive with your view on selecting lenders, looking at costs, looking at experience for your clients?
Yeah, I mean, absolutely. I mean, we all know up until 6-7 months ago for our VA one-time close, how many options do we have? We had one, right? We had one option. Then we had 2. Then we had 3. Now we've got like 6 or 7. So, lenders, I always say, for the same reason that we tell people to get second opinions, for the same reason that, if we encourage borrowers to shop, that's the benefit of us being brokers. We get to shop. We get to go find. I mean, there's so many factors. I've had a couple of borrowers where trying to explain why this lender is priced better than that lender, right? The secondary markets, they're like, how much of their credit is being used? How many loans are they servicing? Did they get stuck with a bunch of loans? Or, all those factors that go into determining what rates they're offering now, like you said, whether or not they can turn that faucet on or off. They're like, hey, we got to turn the faucet down because we got to get rid of all this, all this baggage on our books right now before we can start taking in more loans. So for us, that's the benefit, like 43, 50, I'm with you guys. I think I've got 4 loans with 4 different lenders right now. Right. And it's because this last 2 weeks has just been, wow, what a great time for watching the rates just bounce and be as bipolar as possible, up and down and back and forth. And so, what's
funny, Randy had talked about the services. So almost all of the online services, there is an expert or a guru that's their job. They follow this and they advise us on a daily basis, but they all also have technical charting, or you can get TradingView that has even better charting on it. I don't know if you guys ever, when things get crazy like this, I turn off the daily chart and I put it to the weekly chart, and it puts things in perspective, because when you zoom out, and I try and tell consumers, I say, this is really important. If you want to sit here and drive yourself insane in a volatile market like this, you go, oh my God, I locked on Tuesday and Wednesday was better. Okay, well, Thursday was worse, Friday was worse still, and Monday may go back and be better, because we are literally dealing with that. And in that grand scheme of things, might be a 30 or 40 basis point difference, so 0.3 to 0.4%. So even though on a daily basis things are looking crazy, and you look in the newspaper and it says rates lowest level in 5 weeks, well, that's Freddie Mac Primary Mortgage Market Survey. That was a survey on the phone on Monday that hits the newspapers on Thursday and has zero bearing in what you can actually get out there in the real world. Nathan, kind of closing the loop on that, one thing I was going to ask you, because I think it's shocking to people when you go through and you price out a loan and you go, okay, here's all the criteria, and you push from best price to not even worst price, just say the bottom of the page in your pricing engine. How big of a difference is that for the same loan with the same note rate?
Oh,
Some of them are awful.
yeah. I mean, I'll see, 6.25% maybe par with one lender, and with another lender, it's 7.25. Right?
Yeah,
It's a
I've seen some
full
get 8. It's nuts. Yeah, it's awful.
Yeah. And for us, sometimes you go like, okay, this is my favorite VA lender and they've been priced really well. And there's some criteria in there they don't like that. So they are priced well on almost everything, but not on this one. And you're like, well, we're going to go.
I can't remember if it was Nathan or Randy that mentioned this earlier, but it's like when lenders adjust their pricing, sometimes they adjust their pricing in particular buckets. And so some buckets will actually be better priced or even more competitively priced. And they're like 0.75% different. Like, okay, let's just say a borrower wants to buy down the rate and it's coming down 0.75% in rate. And you're talking about the cost is equal to another lender's 1/8 of a point improvement. Like, it just makes sense. Like, oh, well, I mean, we could take this one or we could pay a little bit more over here, but it's about the same cost. I mean, it's up to you. And immediately people will look at those buckets and say, geez, I mean, again, I'm trying to do the best in providing you your options, right? And so that means I'm actually having to look at the rates for every lender and look at those buckets and see which one's going to be most competitive for you and actually do what's best for you. So once I present those over to you, you're good to go. But those buckets make a big difference with some of these lenders. I mean, you're literally talking about a % difference sometimes in where they're bucketed.
For anyone watching home, when you say buckets, there's multiple different things that could bucket tranches of loans. Sure. Yeah. What are the things that could put you in a different bucket? There's multiple, but someone watching home, what are you talking about?
We're talking about particular rates in particular FICO score, loan amounts. All of these factors play a role, right? And so when they're qualifying that rate and they're telling you like, hey, we're offering, let's just say, a 6% per se, right? And we're charging, let's say, a 1/4 point or something like that. And then you have another lender that's priced at 6 1/4, or let's say 6 1/2, but they're also charging that same amount. It just doesn't make sense. It's like, why would I go here when I can go here and I'm getting the same cost, but I'm taking a way better rate over here. So it's just looking at the differences between lenders and what they're doing for the same profile, the same credit profile, that same loan situation, which is why we all have those pricing engines that we run them through, right? As brokers, we have our loan sifters, we have, through our own systems Arrive and just different ways of pulling up rates. And so when we run those, it gives us the breakdown of the top 5 per se. And once we break those numbers down, it gives us a very clear, defined view of who's best priced where. And sometimes it's a really competitive, like, I can't pass this up moment for a veteran and just be like, hey, look, these guys are offering a way better rate. It's going to cost you a little bit more, but it's worth it. Then at that point, you're just like, okay, well, let me take a look. And once they compare apples to oranges, I mean, they're not going to be the same, but at the end of the day, you're still comparing to see what's going to be a best fit for you. And that works out.
We just in talking this through, we've all just said, hey, we all use a pricing engine. The shocking thing is there are a lot of loan officers that literally don't use a pricing engine. And you hear that and you're like, how would you know this stuff? So if you're pricing 4 loans in a day or in a week and you go, well, yesterday PennyMac was amazing on VA, so I'm going to put them all 4 there because I have to crank it out by hand with a calculator and a piece of paper. Well, you may not know that another investor is paying up for 700 plus credit scores. Another one is paying up for big loans. Another one's running an incentive on this. And it truly shocks me. My wife is a wholesale account executive. She works for one of the lenders that we work with. And she tells me, and she goes, no, this guy does like 8 or 10 loans a month and he still does it by hand. I'm like, what are you talking about? Like, how would you have any idea what is available for your clients out there? So he's approved with multiple lenders, but he's not truly shopping all of those lenders every day. He's going off of his recollection of, hey, who has attractive rates right now, when it's not even consistent through the rate sheet on any given day for different criteria of borrowers.
He still gets his rate sheets faxed to him.
Yeah.
I was about to,
Yeah.
I was about to go there. You beat me to it.
I worked at a big brokerage in the 90s that they had a fax machine that literally it would go through like 3 reams of 200 sheet paper a day. And you're like, you've got to be kidding me. They're changing toner like every day because these rate sheets are coming in. And we seems like one of the experts, you know, that all of us listen to some degree or another is Barry Habib. I remember, I think it was 2003, 2004. We had a really, really volatile week where there was like a 300 basis point move from top to bottom in 1 week. And the phone is constantly ringing with updates from him. And the fax machine is constantly going off with new rate sheets because they lasted about 5 minutes before a reprice happened. So life of a mortgage broker, you guys don't so much care about that. So I think we've done a really good job of covering even beyond what we set out to is what are points? Should you pay them? What's your broker doing to make sure you're paying the least points for the best interest rate? But kind of closing the loop on closing costs. One of you opened up Pandora's box earlier. I think it was you, Nathan. We have 2 things that are more variable than they have been in the past and are important that your loan officer is quoting for you accurately up front. And that's homeowners insurance, which going up rapidly in some parts of the country, not much at all, 5-10% on something that's $1,000 a year doesn't make a big difference. But other parts of the country going up 250% year over year. And you're like, that's a problem. We also, property taxes everywhere outside of California go up with home values. You can get reassessed every year, but every state handles it differently. You get certain different exemptions, and they also reassess kind of a different rates. You'll see a house that you know that would sell for $600,000. The census roll says $320,000. So with that, we all are in different states, operate in different states. Randy, why don't we start with Texas? Because Texas has high property taxes, and just kind of walk us through on the prepaid section on your loan estimate when you're getting, if it's not even a loan estimate, it's a fee sheet, and your broker's trying to prepare you for what to have available at closing. What do the property taxes look like?
Well, obviously, one of the biggest things when you're doing a pre-qual is that you have to really explain to your borrowers that it's going to vary a lot depending on the property that you choose, and specifically what school district in Texas that it's in, because you could be in one school district on one side of the road and be at 3.2% annually for your taxes, and the other side of the road could be 1.7. And so even if they're at the same road, you're looking across at the guy over there is paying $500 a month, and you're paying $1,200 a month for property taxes. So you have to make sure that people understand that, and if it's really important to them, that they're working with realtors that are targeting the right school districts from that perspective. Obviously, some people think the school district is worth it to pay the 3.8%, and so there's this craziness that goes with that. But those people don't always worry about a few bucks. But the big thing is that there's also again, this year has been, last year was a really bad storm, hailstorm world for the Dallas-Fort Worth area, for instance. And so the premiums are a lot more. I used to estimate $125 a deal, and I could usually get them there with using a couple insurance brokers. I don't do that anymore. I'm always estimating at least $175, and that's not always going to work. So I just have to educate those people.
And Randy, what price point for you in Texas? What price point of homes and loans are we talking about for that 150, 175 monthly premium?
400,000.
Okay, because obviously you get $1 million, $2 million home, it's a higher replacement cost. That's going to be considerably higher. Nathan, how's that compare for you out in Colorado?
Well, hold on. I forgot to put on my loan officer badge that I recently received.
Love that.
So everybody knows it's official.
It's an official loan officer badge.
Lay down the
Official
law,
loan
buddy.
officer.
Lay down the law.
I've always erred on the side of caution, so I will always overestimate taxes and homeowners insurance. But for me, like Randy had alluded to, I have some great relationships with some phenomenal insurance brokers. And one thing that we do for our clients is when they are looking at homes, right? We know the zip code typically, right, where they're going to be for the most part. We know the price point they're going to be at. So it's, and based on their credit scores, based on their ownership history, things like that, while you're doing the pre-approval process, a really good step, the one thing that we do is we get quotes from our insurance agents. Hey, what's this going to look like? Now, these are estimates, but these are educated estimates, right? Because, in 80016, where I live, it's going to be a different taxes than at 80134, which is, I'm in Arapahoe County, that's Douglas County. And it's 5 minutes from my house. So, you can, like, as Randy said, you can be across the street. And if your zip code is in a different, if you're on that dividing line, it's important that your taxes and your homeowner's insurance are accurately estimated. Because, here, like for us, Colorado, everyone in Colorado just got a big, swift kick to the teeth this year. My personal homeowner's insurance and my taxes both went up my homeowner insurance went up about 35% over last year, and my property taxes went up about 20%.
Can you said something really important, that you like to overestimate these numbers. And
yep.
Nathan, that sounds insane. When we learned earlier here that if you work in a call center, you can put a really low hazard insurance, an absurdly low homeowner's insurance, your monthly payment looks better, the cash to close looks better. Why would you want to overestimate these things?
That's what's going to happen to these call center people, is when it actually comes time for them to go under contract and actually get real, now there's going to be sticker shock, right? Not only to their monthly payment, but to their closing costs. And, for me, once it's about transparency, and it's about explaining and educating borrowers. Hey, just so you know, we have overestimated this. I don't believe that your homeowner's insurance is going to be this much. However, I don't know. Also, we got to factor in, is there an HOA, right? Are you moving into, like, if the house that you're buying just happens to be on this little hailstorm path that, the insurance companies are aware of, now your insurance now it is what I thought it was going to be. But hey, now it is what I thought it was going to be. You're not going to have sticker shock of everything going up because I underestimated what those payments are going to be. And honestly, to me, I think it's very easy to explain. We'll provide the quotes that we get from our insurance agents just to show them when we do come up against these call centers or some of these other less scrupulous, ethically challenged lenders. Because we know what they're doing, right? It's that bait and switch. Show the low numbers. Hey, that loan looks great. I wish I could deliver it, but it doesn't exist. So.
And it sounds crazy, but I literally had one almost 5 years ago now, a veteran. We locked a rate on Friday. Rates got much worse on Monday, and we actually locked it on Thursday, and they got worse Friday and on Monday. And Tuesday morning, he reaches out and says, hey, I've been asking you about what I could do to get that payment down. And my boss put me in contact with his lender, and we got a much, much lower payment. I said, okay. So he says, I'd like you to release the VA case number so that we can get moving forward. I said, not a problem. Send me over the locked loan estimate. I'll compare it, make sure it is what you think it is. And it comes over, and I said to him, and I said, sir, this says the interest rate is an eighth higher, but you're telling me your payment is lower. And he goes, yeah, look, the payment's lower. I said, okay. When we look at it, it was here in California. So in California, Prop 13, taxes can only go up 2% a year. He was buying from a woman who had owned the home for 60 years. Her monthly taxes were like $112 a month. His were going to be $465 a month. And what do you know? The call center loan officer that works for the biggest retail lender in the country had $112 in there for the taxes. And on top of that, eighth higher in rate, he was paying a point, which we weren't charging him, but it was $375 lower in the monthly payment. And we told him this. He obviously moves forward with us. I say obviously, they don't always do the obvious thing, but they move forward with us. We closed the loan. My business partner at the time put a video online explaining what this lender did. We got a letter a cease and desist letter within 24 hours from their legal department saying that we were defaming them. They had done nothing wrong, but it is a standard practice that a loan officer wouldn't know at the time of origination what the taxes were going to be. I said, well, that's interesting. Thousands of loan officers who magically do this and pre-approve borrowers with real numbers.
Pull out the badge.
Yeah, we needed the badge. We needed to show them the badge at that time. But I mean, that's when we were talking before we came on here that we've all had stories just this week of borrowers being told crazy things. No, that loan officer is lying. Nathan can't really do that interest rate. Well, we're going to build a relationship with you here with the bank, and it's like, this borrower is not someone that's going to have a private banking relationship with hundreds of thousands of dollars there. The loan officer that doesn't even actually have to have a license isn't going to be working at the bank 3 years later. So there's no relationship to be had. I can speak for myself. I bank with Chase. They're right across the street. In the last year alone, I've had 4 new bankers call me. I'm your new business banker. I would like to discuss your account. So we hear crazy stuff all day, every day, and it comes across as self-serving, saying, don't fall for it. Don't believe it. This is what it is, because we're all old dogs. We've done this a long time. We've heard lots of crazy stuff. We've seen and heard it all. It is hard from your end as a consumer to differentiate what's really true. And it's hard.
One piece of advice I'll give to borrowers, especially to the veterans and active duty that are watching this right now, is don't let your ego cost you money. Right? I understand it happens all the time. I have a borrower right now this scenario, right? They came to us, got pre-approved, and then they went to a builder. The builder had some phenomenal incentives for them, right? And incentives that we can't meet, right? We've all been there like, oh, hey, man. And I told my client, like, hey, that's a great deal. If they can deliver it, that's awesome. You need to take it, right? Well, today what happens? The realtor calls me back and says, hey, we need to come back. But the borrower his ego is in there, right? Because now it's like, oh, and it's not an I told you so scenario. It's just a, hey, I understand what these builders do. I understand what these other lenders do. They promise the world and then they can't deliver. Don't let that cost you money. Come back to me, or come back to another broker, come back to somebody, but don't let it cost you the house. Don't let it cost you money. We are not an I told you so. We're not that. That's not how we work, right? That's not who we are. And I've seen it, like you're talking about. I've seen it so many times where someone gets promised something, and that's what those lenders do, right? I used to work for a large retail lender, and they had a course called FUD, Fear, Uncertainty, and Doubt. And that's what we did at that shop. They trained us on how to create that for clients so that we could battle brokers. I remember it very clearly, and I'm ashamed to say I was very good at it. Because I didn't know any better, right? I was a retail lender, and that's what I knew. And hey, our rates are great, our company's great, blah blah blah. But yeah,
Nathan, it's funny that you say that. I'm not going to name names here, but there is a trainer in the real estate industry who wrote a book about conversion and how to convert leads. And he boasted about his time of being a top producing loan officer at that same lender, the biggest retail lender in the US. And what he said their number one strategy is when they got you on the phone and you were doing the application, to make it take as long as possible, so that you thought doing this with anyone else would involve another hour and a half of your time, and you would never want to do that. So it's crazy. We talk about the things that we do. I want to make it as easy and seamless and stress-free as possible. Nathan wants to overestimate so that you never get a bad surprise. It's always a positive surprise. And it's nuts, but this bites us all the time because some idiot out there is saying, no, it's really hard. You would never want to shop someone else. No, these are the real magical numbers that I'm providing. No, you don't qualify for that. I had one a couple of weeks ago in Tennessee. It was an FHA loan, and the lender that we were talking about earlier, they have this thing called choose your price. We can apply up to 40 basis points. And I said, I told this borrower I would do it for him. I said, we just need to decide the lock. We don't get to apply them until the lock. So his loan estimate goes out on Friday. He talks to the retail loan officer who said, oh, he's lying. That doesn't. I said, Why would I lie to you? I got 150 5-star reviews on Google. It takes you 2 minutes to put a 1-star up there saying this guy is a liar. Why would I ever do that? So sure enough, he listens to her, moves the loan over. She doesn't lock the loan. He ends up an 8th higher in the rate, paying a half of a point more on a $600,000 loan. So $3,000 and an 8th higher in rate. For what? Because the realtor said, work with a local lender here in Tennessee. I know her. She'll take care of you. So it's hard. It truly is hard. We know from your perspective, the flip side to what Nathan was saying is don't let your ego get in the way. I always like to say, don't let being a nice guy get in the way. Like, well, this person's been holding my hand for the last 3 weeks, so I'm going to let them charge me 0.5% higher in fees and 1/4 higher in rate because they've been so nice through the process. We're not here to make friends. We're here to have good transactions. So, gentlemen, we are here at 59 minutes. We covered our outline back and forth, and we went 14 different directions that we didn't plan to, but I thought it was really, really good content. We had a couple of comments here. Jennifer Lego just says, hello, mortgage experts. Nick, who's in Tennessee, said very informative. He actually followed up and told us he pays $994 on a $188,000 house in East Tennessee that he's getting ready to close on. So congrats on that, Nick. But appreciate everyone being here. Before we head out, I always like to give each and every one of you a chance to leave some pearls of wisdom, either on this topic or any other. And I usually start on the top row, but Randy, I think I did that to you last week. So we're going to go bottom row. We're going to go counterclockwise. Jerry, what are your parting shots for this week?
No, I think at the end of the day, when in particular to this conversation, it's when you get to talk to one of the vetted professionals here, like, just understand, like, we're all pretty much moving with the same stride and step, right? At the end of the day, our main focus is to provide you with the best options that you have available to you. But then, just like Nathan said, we're going to overestimate on purpose, because at the end of the day, a better surprise is one that's less than one that's more, right? And so a lot of times you really do have to have somebody who's knowledgeable and experienced in a particular area. But at the same time, just because we may not necessarily be local to that spot doesn't mean we don't know what's going on there. And so a lot of times you'll have some really good professionals in this group that are constantly providing loan estimates and providing that transparency, like Nathan was mentioning earlier. And that's all we want. It's giving you the transparency. You let us see one of the loan estimates that you're receiving. We'll be honest with you. We'll tell you, hey, look, if we're comparing even my own to this person's, like, they're better, or that we're right with them. So yes, keep going, like, stick with them, right? It's not about like, hey, no, bring it over here. No, it's, if we know you're getting a better deal, we're gonna let you go there. Why? Because it's what is the right thing to do, because it's about you, not about us. And so, like, more than anything, I think that's my 2 cents. Always start off with a place that you're going to get, honest and truthful direction.
Perfect. Nathan?
I would just stick with, one of the tenets of vetted VA, and that's just, trust but verify. So do your due diligence, and just find someone that you can trust. And if you can trust them, then work with that person.
Awesome. Randy?
Really, the main thing I want as far as our topic goes is for people to think about that box A. And Nathan's example, he said it was $5,100 for $170 improvement from par. So you got 30 months that I want you to understand. The concept is, for the first 30 months of that loan, you could have kept that $5,100 in your own bank account and just supplemented every month. You don't make money on that discount until the 31st month, because that's the point in time when that $5,100 would have ran out of your pocket, and then it would actually be benefiting you. Until that point, you don't benefit. And then to the last thing is, I as far as a vetted VA, each of us could work for whoever we want to work for. We're not young. We're not rookies.
Oh, speak for yourself, Randy.
I definitely speak for myself, but we're not rookies, is what I'm saying. Everybody's got to start somewhere, and a lot of people start at the people that we keep alluding to without those shall not be named. But the thing is they had to start somewhere too, and they're not going to be there after they figure out that they could be wherever they want to be. That's what you have to realize about this group of people that are on this call, is we could all be wherever we want to be. And we personally choose to be where we are because we like providing a benefit, and we don't want to have to do stuff like Nathan was trained at the first, we shall not be named lender. So glad to be here. Honored to be here.
And we are happy to have you, all of you. And I love these conversations every week where we can get together and kind of bring some of the stuff just out in the open. A little of this is just look over our shoulder and maybe hear some conversations that you don't otherwise get to hear. It is a tough housing market. It's a tough mortgage market, just always, because it's not something that you do often. You're not an expert at it. Many people aren't numbers people like us four nerds here. So from that perspective, understand that you have a big burden and it's hard to determine who to trust. And we appreciate you being here and watching and letting at least this hour here every week play a role in that. If you need help, I don't have the map here, but if you go out to vettedva.com, no matter where you are in the country, we have vetted VA pros that can help on both the mortgage and the real estate side. The real estate side needs to be a little bit more local. If you don't have someone local to you in your area, reach out to the person that shows up on the map. Even if it's in a neighboring state, they can absolutely get you connected with a realtor close to you who specializes in helping veterans. So again, appreciate you guys for being here. Appreciate all of you for watching. We will be back next week with another episode. Have a great week, guys.